The four financial statements we will be preparing are prepared in the following order. The income statement first to arrive at net income, then the statement of stockholders' equity, which will include the statement of retained earnings, the balance sheet, which absolutely needs to have the ending retained earnings balance that you just computed on the statement of stockholders' equity, and then finally you'll prepare the statement of cash flows. Looking at it from the big picture, these accounts here are all used to prepare the income statement. These accounts are used to prepare your statement of stockholder equity. And finally, these accounts are all used to prepare the balance sheet. The key thing you should see here is that these accounts circled in the green will all be closed into retained earnings. That makes them temporary. Dividends gets closed into retained earnings. That makes it temporary. So if I were to draw a line right through here, all the accounts below that line are temporary accounts that get closed into retained earnings, which is a permanent account that carries its balance forward from period to period. The financial statements articulate from one period to the next. What we do is we take our beginning balance sheet and then we have the other statements that help us explain how we get to the ending balance sheet. For example, the income statement tells us how retained earnings changed from one year to the next, or from one period to the next. It gets added to retained earnings, whose ending balance will then go on to the ending retained earnings. So we take our beginning retained earnings from the beginning of the year, add net income, take away dividends, to get our ending retained earnings, which goes on the ending balance sheet. Common stock the same. We take the beginning common stock. We might have issuances of common stock, for example, to get to our ending common stock, which goes on the balance sheet. Changes in the cash account can be explained by the statement of cash flows. We take the beginning cash, add to it all the changes in cash from the year to get to the ending cash, which goes on the balance sheet. This here in the middle is called articulation. The balance sheet from one period articulates to the balance sheet at the end of the period using these other statements that explain the changes.